Hey everybody. So if you ask the average person if they have experience with a credit card or line of credit, they will usually say that they have more experience with credit cards than a line of credit, right? And so what we want to do is get the best of both worlds because even though a credit card is technically a line of credit, I do put it in a different classification than a personal or home equity line of credit. And so the biggest pro of a credit card is that if you're always paying the statement balance in full, you have a 1 month floating period to pay off that statement balance, and then you will never accrue interest, right? But of course, a lot of people carry balances, which is how the credit card companies make money. But the biggest pro that a credit card does have is think of it as like a 1 month free loan. Every time you pay the balance of that loan in full and then you swipe again, it's another 1 month free loan, right? Now, the biggest pro of a or personal equity line of credit is there tend to be lower interest rates. So every personal line of credit that I've taken out has been about 15%, whereas home equity is usually about 7 to 8. And so we want to take advantage of these pros and use each tool for the appropriate situation. Now, the cons of a credit card is that you're going to deal with higher interest rates, right? It's pretty normal to see 20 to 30% interest rates on a credit card, but this will only happen if you carry a statement balance. But the con of a personal or home equity line of credit is that let's say you use that money for 1 day and then you pay it back the next, you're always going to accrue interest. So there's no such thing as a 1 month free loan when it comes to a line of credit or a personal home equity line of credit. So what we want to do is we want to combine the best of both worlds. So as we're paying off debt, yes, we do want to pay the credit cards, but it doesn't mean we never use them again, right? And we were obviously going to use a line of credit until we have all of our debt paid off. So let me just kind of show you how we do this here. So, obviously, in this first column, we have the average American banking style where we have our income, expenses, we pay our bills, including our debts, and then we put the leftover in checking and savings, right? Now, with the second column, which is what we call the velocity method, formerly known as velocity banking, but we can't use that term anymore, we don't save money and then we dump all of it into something called a line of credit, right? So as you can see right here, we have a lot of credit card debt and we're going to assume we have a $60,000 line of credit. Now, the first thing we try to show is that, hey, if you just did a balance transfer of these credit cards and we rank the credit cards or we rank the debts using the cash flow index, which is just a formula of the balance divided by the payment, right? So this is the lowest ones and the highest ones you want to pay off last. And quick recap, why do you want to pay the highest one off last? Is because you have to pay a lot of money for itty bitty amount of cash flow, right? Whereas with the credit cards, let's say you pay this one and this credit card, you'll get more cash flow for let's say $42,000 of credit card debt for about $1,300 a month, and the mortgage is only $250,000 a month, and you only get about $1,200 of cash flow, right? So you think about bang for your buck. Okay, so what we're going to do is we're going to move the credit card debt, which is about let's say $55,000 here into let's say a $60,000 line of credit. Now, what happens when we just do that balance transfer, right? Well, these payments go to zero. Now, assuming that we're going to use the method that we've always talked about, which is that we're not going to save money, but we're going to put our entire paycheck into the line of credit, take our expenses out, rinse and repeat over and over again. Even though these payments are zero, does that mean that we're never going to use credit cards again? And I would say, just get the best of both worlds, right? So if I take a look at the actually, is this it? Where did it go? Oh, actually, if we take a look here with the pros and the cons, let's get the pros, right? So as we're paying off our debt, let's use the lower interest rates to help pay off our debt. But then also, um, we want the 1 month floating period of no interest. So what we're going to do is that you see the items with the personal expenses right here that are not tied to debt, food, gas, insurance, and all that. What we can do is with the 1500, maybe spread it between the four credit cards, or maybe use one credit card per month to pay off the 1500 so we could get a 1 month free interest loan, right? But we're still going to use the credit cards, but we're just going to pay them off and this is going to essentially shift to here, but it's still going to be part of this. This will still be a line item in our cash flow because we're going to pay off the entire credit card balance, but just 1 month delayed, right? So obviously, when we're using the strategy where we're putting our entire paycheck into line of credit at 8% and then paying off our expenses, we're still going to use a credit card. So even though here we say, hey, these credit card payments are zero, what we're actually doing is using one of these credit cards to pay for our expenses not tied to debt, food, gas, insurance, and all the other good stuff. Get the statement balance, wait till the very end possible, and then you have a 1 month free interest loan, right? Or interest free loan. Okay. And so let me just kind of quickly demonstrate how this works. So we're going to take the previous month's balance, previous month's interest, minus our cash flow, 1856.45. And then what we're going to do is take the average daily balance, right? And then multiply by the interest rate times 0.08 and then divide by 12. Okay. And then I'm going to go ahead and copy and paste. And then so you see after every single month, we're still using the credit cards. Okay. We're still using the credit cards, but we're paying them off probably 1 month later than we should. So if we're purely using a line of credit, this interest number will factor in that we're paying for expenses from the line of credit at this moment. But hey, if we're using credit cards, some of that interest will move on to here. So this will be a little bit lower, and this will be a little bit lower. So you're just shifting the interest for a month. So and so the time payoff should mostly be the same, but the interest should be a little bit lower because we're delaying it for 1 month, right? And we're not going to pay interest on the credit card. So let's go ahead and do that. And then we see that, hey, that was really easy. We paid it off in 33 months, right? And then we rinse and repeat over and over again, still using the credit cards to pay these personal expenses while using our line of credit to pay our other debts, okay? And so 33 months, and then this is going to be about 55K of debt. And then I'm going to go ahead and copy and paste. And then we have our auto loan, student loan, and mortgage. And then I'm just going to do this. So 33. Okay. And then I'm going to copy and paste. And then we use the cash flow index. So as I said before, the cash flow index is just a ranking system of how you pay off your debt. The lower the number, the more bang you get for your buck for paying it off in terms of cash flow. So even though this is the highest interest rate here, which is the $65,000 loan, we're going to focus on the 3% auto loan first because if we pay it off, right, we get 10 grand, or we pay 10 grand, we get about $400. Whereas if we pay this 51 grand, we only get about double the amount in terms of payment. So it's faster to pay this off, get that cash flow, and then apply it to the next debt, right? So I'm going to go ahead and do that. And I'm just going to copy and paste. And then we're going to just do this plus 10,0308.69. And then this is going to be auto loan is 0 right here, right? Auto loan is 0. 2251.76 is our new cash flow, right? So let's go ahead and update our cash flow right here, which is minus 2251.76. And then I'm going to go ahead and copy and paste. And then we see that in 38 months, this has been all paid off, right? So 38 months. And then let's go here, month 38 months. And that would be 55K, or I'm sorry, 55 plus 22K, so that'll be 77K. Okay. And then so we have our student loan and the mortgage, so that would be 38 months, so 38. And then we just follow the cash flow index again. So we have a loan where it's 7% and line of credit's 8%. You'll probably end up paying a little bit more if you move it into the line of credit, but it's okay. So I think we'll be fine for now. Let me just do this right here, and I'm going to go ahead and copy and paste this. So we're going to move the current loan into the line of, whoopsie, hold on. Oh, we're moving it here, my bad. So this is going to be plus 49075.99 4907.99. And this is going to be an extra $700 back in our cash flow. And our cash flow is 3 grand, right? And we're just going to do this right here. So I did this from a previous presentation or the previous video, so I have it here. So 3006.46. And then we're going to copy and paste. And let's go ahead and copy and paste all this. And then we see that in 56 months, okay, we paid off that student loan. So we're going to just do this right here, 56 months. And then that's going to be 77 plus 65, and that's going to be $142,000. And then this is going to be the mortgage, 30-year mortgage. What's the balance at 56 months? It's going to be 227. So remember, during our journey, we still have these expenses. So think about how if we were even debt free, we'd still have to pay the 1,500. Now it doesn't mean you have to close your credit cards, but we're going to use all these credit cards to just, to $1,500 up to that limit, right? So we just do that and then just keep spending, get some rewards points, get a few extra bucks. And that's what happens every single month, right? We delay some of the interest per month because we're always paying it off in full, right? We're always paying it off in full every single month, okay? And yeah, it was pretty much that's pretty much it. So hold on, let me think about this. Okay, so now we're at the stage where we're at the final stage where we're paying off the 30-year mortgage. And so if you've listened to this channel for quite some time, I told you some nuances about the 30-year mortgage that you'll never hear in any other channel, which is that you don't want to move the whole 30-year mortgage into a line of credit because you're moving a huge loan with very little cash flow into a much higher interest rate vehicle, right? And you've seen the demonstrations where I use this calculator where I said, hey, let's say you move the whole loan into a line of credit, and then that's 57 grand. But if you just kind of let's say do small chunks, small sweeps into the loan, look how much less you pay. That's 24 grand, right? So even if you use a 30% credit card in this process, you'll end up paying less than putting the whole loan into a line of credit. And it'll probably even be, I don't know if might be less than this, because think about if you made swipes of, let's say, your monthly cash flow, then I don't think would they even charge interest? Yeah, let me think about that. Like, this is assuming that we're being charged 30% interest annually, and then you divide by 365 on a daily basis, right? So I don't even know if you would pay this much. Maybe you would because of the plastic fees. But yeah, okay. All right, so let me just kind of go here. And so now this is 56 months, right? So how much is it? I think, hold on, 227,863.46. Yeah, so this is going to take about 5.2 years, but let me do this, to pay off using the chunking or sweeping method. And if you don't know what that means, basically your strategy is to take a small piece of the loan and then move it into the line of credit. And so I'm just going to kind of go here and here, right? So let's say we move $6,000 from the loan into the line of credit. And I'm just going to do plus 6000, right? So you're still making the monthly payment, and then you see that in 2 months that 6,000 principal, and a little bit more because you still have the monthly payment, gets eliminated. And so you do have a $10 a month interest cost for using that line of credit. But I was thinking, like, let's say you do swipes every single month, right? And you pay off the whole credit card a month. Could you delay interest that way? And I'd have to think about that. But let's just assume we're using a line of credit to pay off the loan, and you see that every 2 months or so it gets paid off, and then we just rinse and repeat over and over again. And then, yeah, that's pretty much it. So it says, but again, we're still using the credit cards because these are for non-debt line items, food, gas, insurance. And usually when we create our budgets, just to make the process simplified, we just combine them into like averages. Oh, you're spending about $1,500 or $2,000 a month for your general expenses, right? Food, gas, insurance, electricity, utilities, just living, right? Living, even though living is getting more expensive, and it seems like nowadays you got to be a gajillionaire just to be a normal person, because the average person is being squeezed out. All right, so now this is 0, and then this is going to be, what was that again? 5.1 years. I need to take a look at this. Daily wire collapsing. I was watching videos about that, but it's okay. We'll just close that for now. All right, so 5.1 years, and then this is going to be 56 divided by 12 plus 5.1, and then that's 9.77 years, and then we're debt free. All right, so that's it for today, folks. It's yeah, just another review of using a line of credit and credit card combo just for your personal expenses. So the strategy is get rid of your credit card debt or debt balance, the statement balance, paid off, or try to get to a point where you paid off. And then once you do pay it off, then use it for your general expenses as you're still using your line of credit um, to pay off the other debts. Okay. All right. Well, have a great day, everybody, and I'll see you on the next video. And don't forget, if you made it to the end of this video and you want to let me know, write in the comments below, number one debt payoff channel. Number one debt payoff channel.